And here's a view then coming in on the fundamentals of the market. Nilesh Shah, MD and CEO at Envision Capital. Here's what he had to say.
The strength in the Nifty, or the 4 to 5% up move in the Nifty, is coming mainly from two pockets. One is Reliance Industries, which has had a remarkable run in August. It's given up a lot of the underperformance which it has had. And second is the technology pack. Clearly with the leaders essentially in terms of stock price moves, having done better on expectations that the technology spending environment is not as bad. And that some of the players are now kind of getting a little more aggressive in trying to win price bids. So I think it's clearly these two pockets which have really driven the Nifty. But I think rest of the pack in the Nifty space, I don't think has done as well, whether we look at PSU banking or auto, or metals or any of the other infrastructure names. By and large, I don't think they have been real outperformers or outliers in the month of August.
So at these levels, which is level of about 5,300 plus on the Nifty, 17,000 plus on the index, where is risk, where is reward?
Clearly, I think the risk still continues to be in the high beta names. Clearly, that's where bulk of the liquidity has gone into, where expectations have been running very high, expectations of policy initiatives, which would basically change the operating environment for some of these sectors. So be it PSU banking, infrastructure, metals, to some extent automobiles. This is clearly the pack where we believe that the risk still exists. A lot of these stocks are still significantly higher from their December lows. So there's still some money off the table which can be taken by some of the investors who perhaps would have bought.
So we expect infra, autos and perhaps banks or PSU banks to cave in.
I still think that the downward move that we've seen in the last 1 week or so, that's something which can still kind of continue over the next few weeks, few months, particularly if the expectations in terms of rate cuts or expectations in terms of any of the other economic reforms do not materialize. Then given that they are high beta, you will clearly see a downward move. In addition to that, if globally we see any negative news and the risk on converts into risk off, then these are really the pockets which will really be very vulnerable in the event of liquidity getting sucked out. On the other hand, in terms of returns, clearly the outperformers would be 2 or 3 broad segments. One is basically sectors where are having dollar revenues, be it technology or pharma, or selectively even auto components who are basically suppliers to global OEMs. Or if the auto components have the other opportunity in terms of the replacement market. So clearly one is sector where the revenue, where there is dollar revenues to be made. The second is the Agri pack, which has been underperforming because of expectations of a drought or a very weak monsoon. But clearly we've seen that the monsoon is picking up. The extent of deficiency, which was probably between 20-25%, is now down to about 15% odd. So clearly it's not as bad as what it was thought out to be. Maybe that's the second area where there is basically some expectations of outperformance or returns.
When you say Agri, it's a very large basket. Break the Agri theme for us. Do you like tractors? Do you like pesticide? Do you like fertilizers? Do you like seed companies?
I think it's going to be Agri inputs, which is a combination of fertilizers and seeds and the pesticide companies. And within that, it's the fertilizer and the agrochemical companies, which as stocks have not done anything for the last year and a half. If at all, a lot of these stocks are still down about 25 to 30% over a 1 year kind of a time frame. The seed companies, there's really not much to pick and choose from, barring some very illiquid small cap names. But clearly the agri input companies are really the place possibly which have been underperforming, and that's really the place where one can look at in terms of outperformance.
So if you're negative on autos, which means tractors are out, I'm sure you don't like fertilizers because there is a subsidy problem there. Knowing you, you'll not invest in fertilizers. So we pretty much are left with agri inputs, and in agri inputs I can only think of 2 names. And the other one, you know.
Yeah, and I think there are probably smaller companies which are still not yet into the formulation stage, but make bulk, make technicals in agrochemical space. So I think those are some of the names to look out for. There are a couple of multinational names out there. In addition to that, I think some of the agri credit, I mean some of the NBFCs which are focused on agri credit predominantly or are more biased towards the rural areas in terms of credit demand, that's one area to really look at. Within auto, I'm not quite sure whether there is too much of downside in the tractor companies at these kind of levels. When I look at auto, I think it's still basically the passenger cars and two-wheelers where you clearly see still one more difficult quarter.
Even though Mahindra and Mahindra has given us a scary warning, they've indicated that instead of 10%, they will grow at 2%. You like tractor companies?
But I think the valuations in a name like Mahindra and Mahindra is relatively more attractive, given where the valuations were a few months back. One is not saying that it's going to be a terrible outperformer, that there's going to be serious double-digit returns and those kind of things, but it's more in terms of relative outperformance, given that these kind of names have not done too well as stocks. Probably there's some amount of outperformance which can come in, given that the monsoons have not been as bad as what it was perceived to be 2 months or 3 months back.
So Mahindra and Mahindra is your preferred large cap idea?
I mean, that's surely one idea which has the potential to kind of outperform, apart from, of course, some of the technology names or some of the larger mid-cap pharma names.
This year so far, we've got about $13 billion of fresh inflows. That's some kind of a record inflow. But if I look at the market breadth, the market is getting extremely narrow. Polarized is the right word because FMCG is moving up. Some IT stocks are holding on. Maybe an odd infra company. That's about it.
I think this is a very typical characteristic of a bear market, where in a bear market, the rally is narrower and narrower. It's never a broad-based rally that you see. And I think companies where the revenue visibility is good, earnings growth is good, cash flows are strong, and balance sheets are lean, neat, and clean, clearly those are the pockets where outperformance comes in. Those are really the pockets which where valuations may even get more expensive or even a little more stretched in comparison to a lot of the other sectors where there are issues of balance sheets, there is high debt, earnings visibility not being there. So clearly I think this is really this is like a situation which India probably witnessed in the late 90s, where a lot of companies with relatively clean track record did get disproportionately higher valuations, and rest of the pack just kept falling by the wayside.
HUL, first my compliments and then my question, my compliments, because exactly on the same forum in 2009 December you said HUL is a good stock to buy and the stock is up 100% from those levels. 520 is the current price for HUL. Is HUL fairly priced?
I think it's fairly priced.
But
maybe it's also overpriced. And therefore I think clearly if you're really looking out for those very solid double-digit absolute returns, maybe it may disappoint you at the current price levels. But I think for institutional investors who have compulsions to be invested, and if you're owning HUL or if you're underweight HUL, maybe you want to basically still hold on to your position, given that HUL still has the ability to outperform. So it's quite possible that if the market corrects, HUL would correct a lot less or may just be go sideways, and that's really been the trend that we've even seen in the last few sessions. So I think as long as the investment cycle does not pick up, clearly liquidity and the markets would be biased towards the consumption-oriented names, despite the fact that valuations are no longer cheap. Valuations are not just fair, but they are more than fair, and probably, as I said, that maybe they're really on the higher side.
3 large cap stocks where you're confident of a double-digit return in next 12 months.
Okay, I think over a 12-month time frame, I clearly believe that the technology pack has the potential to deliver double-digit returns.
Something like TCS also, even though TCS is at an all-time high?
I think Infosys probably is on a relative basis, Infosys is better, because I think right now if I were to kind of look at valuations, I think the expectations are that TCS can do no wrong, and the expectations are that Infosys will not do anything right. And I think clearly therefore there are huge valuation differentials between the two. And I clearly think that a lot of the valuation gap which is there today between the two names will get bridged over the next few quarters or maybe over the next 1 or 2 years.
What is not justified? TCS trading at a P multiple of 20 plus, or Infosys trading at a P multiple of 12? Will Infosys move up or TCS come
I think
down?
Infosys has the potential to move up.
So TCS you think at 20 times deserve to trade at 20
Yeah,
times?
because I think if you really look at these companies, they're still growing at about 20% in rupee terms. If not dollar terms it's still single digit, but in rupee terms they're growing at double digit rates. There aren't too many sectors, too many businesses which are growing at that rate. These companies again have all the other characteristics of a good balance sheet, cash flows, healthy margins, good quality management. So on one hand, if you have the conventional consumer names trading at 30-35 times, there's nothing wrong with the frontline IT companies trading at close to 20p multiples.
Within PSU banking or beating down infra or maybe, bashed out real estate, where is deep value?
I still don't think that there is deep value in any of, if you were to just look at sectors barring, rather than kind of getting into individual stocks, but I think all the three pockets, still stress is going to come in.
Even metals? Most of the large cap metal companies are below replacement cost?
Even now. The reason is because if these metal stocks traded well above replacement cost for very long periods of time, I think they can trade below replacement cost for very long periods of time. And that's because one is dollar realizations are going to be under pressure because of the global economy. Volume of take is going to be very limited because of the domestic economy. And on top of that, if you have debt and if you have uncertainty about the mines which you own or any of the other land which you have to yet acquire, I think these are serious, I would basically say that dampeners in terms of stock prices.
Okay, those are views coming in from Nilesh Shah from Envision.